Foreign exchange reserves have always been useful in times of a financial crisis, as a country's central bank can buy up its domestic currency to help support an exchange rate that is beneficial to various parties, including the country itself. We've seen this take on extremes in the US and in particular Japan. But how long can a central bank such as the Federal Reserve go on buying up the domestic currency without needing a bailout itself? Well, I'm speaking to Sebastien Galy, a senior FX strategist at Societe Generale in New York, on the role foreign exchange reserves play in today's financial climate. He joins me now. Before we take a proper look at FX reserves, I'd like to talk currencies with you, Mr. Galy, at the moment, specifically euro-dollar. It was rapidly on the rise last week, but has it settled now ahead of NFP Friday?
Yeah, I think what you saw initially is because of the fears of tapering, as market trades European curves in a correlated fashion with U.S. Treasuries, there was actually more aggressive repricing of the European curve than the U.S. one, which helped euro dollar to move sharply higher. Since then, of course, people have readjusted their views, look at high yields in Europe, look at what the ECB will probably do, which is try to maintain as easy a position as possible, also a fairly deflationary environment, and that means we're going to see basically that readjustment between the European curve and the dollar curve becoming more and more evident as Fed tapering becomes more and more in fashion. Next stop, of course, is Nonfarm payroll, but very, very soon we're going to get also some better data releases, probably coming out of the U.S. All of this reinforces the view that the U.S. Treasury curve has to reprice, has to become a little bit steeper, and as it does, the dollar should strengthen. And I think a lot of people are not necessarily as long dollar as they would wish to be, and therefore they're using setbacks in the dollar to build back up their positions.
Okay, for those watching and listening who may want to know more about foreign exchange reserves, is it possible for reserves to literally run out?
Yes, it does happen, and when it does happen, the currency essentially collapses. So that typically when you have a currency which is pegged and at unsustainable levels, and then what you see is foreign reserves steadily decline. And as long as you have a partner willing actually to provide these reserves, the system can be maintained for quite a while. So, for example, I lived in Africa, and I got a place called Cameroon, which was linked by a peg to France at that time in the French franc, and it was operating at an exchange rate level which was deeply unsustainable. They were able to maintain that system only because essentially they had a subsidy coming out of France for quite a while to maintain the system. Eventually it was so unsustainable that they had basically to revalue their currency by about 50%, which was a very, very severe move, which eventually helped that country. So foreign reserves can dry out. But what will typically happen in a more normal environment is that you'll have a country which is somewhat in trouble. Investors pull out. The amount of foreign reserves which are on hold in that country are insufficient. The market can feel that the central bank will have to capitulate, as happened, for example, under the ERM system with the UK. And when it feels the blood, then it doesn't really matter at one point how much money you have on your balance sheet if it's not enough. You're unable to maintain your credibility, and therefore your currency comes under extreme pressure. So you maintain your reserves, some reserves, but they're unable to sustain what was an equilibrium which was unfortunately unsustainable.
Can you see this happening with the Federal Reserve and the rising dollar, for instance?
I think their fear is not on their foreign reserves, it's more on the balance sheet of the Fed, which is of considerable size. If yields would rise in the U.S., it would basically reprice the value of these assets, which of course would be a significant P&L hit. It does not matter too much as long as they can hold these assets to maturity. Nonetheless, it could eventually become a negative for the Fed in the sense that you could imagine in some very extreme scenario whereby eventually the government would have to subsidize the Fed. But certainly at the level of the Fed, it does suggest that because of the size of its balance sheet, there is an incentive for it to taper just to, in a sense, to protect itself against a very extreme scenario.
Okay, what would be the resulting effects if the Fed itself needed a bailout, and how would this affect the currency market?
As we move ahead into a normalization in the U.S., and the Fed looks at its own balance sheet, then are some probably within the Fed which will look at that kind of a very, very tail risk and simply don't want to be involved even in the probability of that tail. And that will be one of the reasons why they will want to taper. So these kind of incentives are not unique to the Fed. They're basically everywhere. You saw, for example, the ECB managed its collateral rules very prudently under the European crisis because they didn't want to see some sovereigns default on it, and it being basically like taking such a negative P&L loss that it would have to have money transferred to it by other entities within the European Union. And therefore, for quite a while, it was extremely protective and remains protective. For example, it no longer accepts, I believe, some bonds from Cyprus for technical reasons last week. I think they're accepting in the next week.
Finally, Mr. Galy, do you predict a further decline in global foreign currency assets?
If we think about global foreign reserves, these are rising because to some extent, because initially we had some deep appetite to build up dollar reserves from emerging markets to try to compensate for the risk of outflows. Net, what probably is happening is that global foreign reserves are seeing some significant outflows because of different bursts that we've seen, and then they try to reverse that and rebuild a little bit some of their dollar positions. We saw the impact of this, which is in the U.S. Treasury market. They seem to be selling U.S. Treasuries and building up their dollar cash positions. So net the amount of U.S. Treasuries and other assets held by central banks are probably going to decline going forward. But if you can imagine 1 or 2 or 3 or 4 quarters down the road, we'll probably see a significant reversal of that, which is that emerging markets do not want to see their currencies appreciate. There are valuations which are more expensive than they used to be. Their life has become more difficult with China achieving a more mature state of growth, and therefore the incentive to intervene in the FX market are going to be a more increase than they were before. So the odds are that we actually will see the share of dollars held by central banks increase, and this at the expense particularly probably of the euro.
Okay, that's all for now. Keep checking back for our hourly updates and interviews, but for now, goodbye.